If we're beginning with the end in mind, the end is success, franchise success. How do we get there? What is private equity value? As a new franchisor, as an emerging franchise brand, what are the check mark items that you need to be focused on today and over the next 24, 36 months from now? It's all going to start with franchisee profitability. Coming up next. Alicia, we're going to have fun today. I'd like to introduce you to Alicia Miller. And if you're sitting there right now, also just check out on Amazon Alicia's book, Big Money in Franchising. And as I introduce Alicia, here's the key. Alicia works with private equity. She works with franchisors. She helps them scale to close an equity transaction, and she helps brands grow. So if you're a new franchisor, if you're thinking about franchising, whether you want to sell or not, whether that's so far in the future, let's begin with the end in mind and talk about what it takes to really scale a franchise system. So Alicia, welcome, and I'm glad we're having this conversation.
Thanks for having me. Glad to be here.
So Alicia, we're going to start this conversation. Your book's amazing, right? A lot of buzz, but what's the one big secret to create a successful franchise system? And by the way, I know there's no answer to that one thing.
No, there is an answer.
Let's go.
There is an answer. Franchisee profitability, full stop. If you focus on making sure your franchisees are profitable and they're getting the payback that they feel is fair for their effort and their capital, then in the end, you're probably going to win, whether you're an emerging brand or whether you're a large brand. And, having the end in mind, thinking about maybe doing a transaction with private equity, that's great. But if you do all the right things and you build smart in the first place and you're preserving that franchisee profitability, then you can take private equity money, or you could delay it for much longer. It's up to you. But in the end, the process of thinking about the end in mind and what private equity values the most, ironically, helps you deliver great value for franchisees.
Yeah, you nailed that one. And so for our audience, we have so many amazing entrepreneurs thinking about franchising and emerging franchisors. And our team gets calls every day, Alicia. Some of them feel stuck and maybe they didn't get the right advice from a consultant. But guys, what Alicia is discussing right now, I feel like is so overlooked for new franchisors, which is your existence as a new franchisor, your mission is to onboard like-minded franchisees and to make them successful, make them super profitable. So let's dive into this. How do we make our franchisees profitability? For me, one key factor that I see for new franchisors, they don't understand the economic opportunity they're offering a franchisee. And we have a great chart we work with our clients where we're like, okay, are we a lifestyle business, supplemental income, income replacement, legacy building? How does that relate to item 7, estimated initial investment? And how do we position out of the gate? And I feel like so many new franchisors get that wrong. So what's your advice there? And what could you share on those points?
Yeah, I agree with that. I think, ideally, we're trying to be transparent about what the franchise is and is not, so that you can try to present yourself in a particular way so that you automatically kind of attract people who will be interested specifically in that, right? The challenge, I think, for a lot of emerging brands is that initially they don't have a lot of infrastructure. So they tend in the early days to attract entrepreneurs themselves who are comfortable with the fact that there isn't a lot of infrastructure. They kind of like getting it on the ground floor. They're a little bit more of a maverick personality. The challenge is that if you're not providing the infrastructure and the support, then at some point you're going to hopefully layer some of that in. And what you then start to want to recruit more are people who can follow a process. That's different than the personality of an entrepreneur who may want to do things their own way. And so there are these very common inflection points that can happen with emerging brands where there are almost like thermoclines in the personality profile of the earliest franchisees compared to ones that are coming later. The best thing you can do for your emerging brand is to try to really nail those processes as early as possible. Try to have a few corporate locations that are humming along really well, and you've got a process where you're recruiting entrepreneurs to make up for the fact that you don't have the infrastructure. If you can get the infrastructure in place, or at the very least get more of a process approach in place early, then you can leapfrog that element and you can get to recruiting franchisees who are more process based. And that's what really drives scale in a franchise system.
So, Alicia, if you had to give 3 characteristics of a process-based franchisee that could be a great fit versus the entrepreneurial franchisee that may not be a good fit for the system, like what would be some of the factors you're thinking about?
First signals are how well do they follow your franchise sales process in the first place. Hopefully, you've designed a thoughtful franchise sales process that has very distinct steps that you want people to follow. And, the question is, can the franchisee follow them or not? I tend to be more independent and I am known to go around any obstacles that I find. And I, wouldn't necessarily be a good franchisee in some systems for that reason. I'll jump right ahead and go pull the FDD off a free site and I'll start calling franchisees before I've even, talked to salespeople. So if you were looking at that behavior, you would say, I don't know if Alicia is really going to follow the process. I think Alicia is going to do what she wants to do. That's a signal that you need to pay attention to when you're recruiting Alicia into your system, that she's going to do her own thing. In the long run, you want independence. These are independent business owners. You want an ownership mindset, but you also want people who can follow a system, because if the system's good. I think the other place that emerging brands get themselves into trouble is, like I said, they haven't nailed that system. So the system's got to work and lead to profitable units. And then you can, recruit franchisees who are going to follow that system and everybody can succeed.
It's such a foundational point that you're making, but it's the one that I think is overlooked so much for franchise brands.
Yeah.
And I love this conversation because it's something we struggle with internally, our team, in making sure that when potential franchisors contact us and we can't work with them because they're not ready or their unit economics aren't in line, we do struggle. They sometimes get upset, right? And there's other companies that work with them. And I'm always looking to give a better platform for them, understanding why they're not ready yet.
Mm-hmm.
And I think so many companies out there are overlooking the fact of we really need to build this around the profitability of your franchisees, those franchisee avatars. And there's just too many of these new franchisors out there. They really don't understand and know the direction. But so we're beginning with the end in mind, right? And I will be redoing the intro to this video, and it'll be talking about the first words out of my mouth will be about franchisee profitability, right?
Yeah.
So beginning with the end in mind, whether we're an emerging brand or we're looking to secure a deal with private equity, your first advice is let's focus on the franchisee profitability. So what KPIs and metrics should franchisors have on their dashboard at all times? And I know it's going to vary based on industries, but what are the core KPIs we should be focused on?
Sure. From my perspective, I think franchisees need to be making at least 15 to 20% EBITDA margin once they get going, because otherwise you would just put your money in the public market and some of my stock is doing really well in the public market. So, and that's a passive investment. So you would have to expect an active investment that I'm involved in every day should perform better, right, than the public markets. Your payback period should be ideally faster than 18 months. Best in class would be 12. That's tougher for some of the more, the larger brick and mortar kind of opportunities, but you want a franchisee to make a good living coming out of this. And it depends on the staffing model of the business you're in. So if the model scales best with a manager in place, then you need to afford that manager and still kick off enough cash flow to the franchisee to make it worthwhile. Sometimes franchisees can get into this trap where they open a lot of units because the only way they can make the living they want to make is to own 6 of them. Well, to me, that's sort of false logic. Each unit needs to kick off healthy cash flow and then, add units from there. But if you're cobbling together a bunch of units because collectively you can make a good living, that means, in reality, each individual unit is kind of skating on thin ice. So you want to try to avoid that.
Yeah, these are critical KPIs. So I want to dive into this a little here before I even dive in, because I want to discuss separately service-based businesses versus retail brick and mortar. But even before that, one question I get often is, how much money does a franchisee need to make? And of course, it's going to vary on industry, for my franchise to make sense if they're going to be owner operators.
Well, that depends on the franchisee and whether it's a full or a part-time commitment. There are part-time franchises out there that are designed in the first place to be side hustles that are great little businesses that kick off, $50,000 to $100,000 in free cash flow, for example, with not a very large investment. But they are very transparent about, what it takes to be successful in those businesses. Even as a side hustle, you still have to put effort in, right? Larger businesses with a big brick and mortar commitment, a minimum from my perspective would be 150 to 200,000 in free cash flow for the owner. Otherwise, there's plenty of other jobs you could probably go get that's less risk that would pay you kind of in the same ballpark. But in a larger, if you're launching, a large elder care facility or an entertainment park or a restaurant, you might want to see a lot north of that. So in an owner operator model where the AUVs are just not that high, that you've got the franchisee on this treadmill that just never ends, right? They can't sell it. They can't hire a manager to take over to make their lifestyle easier. And they're not making enough money to make it worthwhile, which is the stress. And you see in a system like a Subway where the AUVs are just low for that owner operator. It was kind of designed to be an owner operator model. They can't get a break. So that's why you're better off designing it so that the owner operator feels it's worth their time and effort to be the owner operator, or hopefully even better, can hire help. It kicks off enough so that you can afford a manager a few days a week. So you get a break. Nobody wants to be tied to their business 7 days a week, 24/7. I don't think many people get into franchising. You're just trading one set of shackles for another set of shackles, basically.
This is where the success is built. So in one of our videos, and we'll put the image up here, we have our economic profile of a franchise investment, right? And you have the different access, higher estimated initial investment, higher ROI potential, and how does the business fit in, right? Lifestyle type business where I'm passionate about what I'm doing, income secondary, supplemental income, part-time business, it's part of my lifestyle. Income replacement, legacy building. For the franchisors out there, get your economic profile right. Because for me, when our team's working with a franchisor, this also translates into how do we develop and assign territories, what our territories look like, what multi-territory looks like, what our item 7 shows in terms of estimated investment, and the deep dive data that we're focused on in our item 19, right? If we're a retail brick and mortar legacy building business, we better have a very deep item 19. And likewise, if we're a lower startup cost service-based business that can take you from income replacement to legacy building, then we're focused on key KPIs, right? Beyond gross sales, cost of goods sold, labor cost, non-managerial labor, managerial labor. So I think these are all critical factors to focus on. Where I see brands go wrong too, Alicia, is I'll see them working with a sales organization, they're growing quickly, and maybe they're just designed to be a supplemental income business, but they're stacking and selling multiple territories to a single franchisee. And that franchisee then pays a high initial franchise fee. Nothing wrong there, but he or she now thinks that supplemental income business or income replacement business could be legacy building, where it turns out the income from 4 territories isn't 1 territory times 4. It's very hard to grow that business. And that's something I'm seeing happen more often.
Yeah, I think so. There's a couple. Let's unpack that. So I think another mistake that's commonly made is franchisees are allowed into the system without adequate cash cushion to carry their expenses. So usually in the FDD, they have 3 months of cash. I would say at least 6 is probably more realistic. Also, people need to recruit franchisees making sure the franchisees understand that even if it's designed to be a side hustle or they're eventually going to make it a passive income, that first year especially often ends up a full-time job. There's a lot going on to get a new business rolling and to get it functioning well and to get the team, the team has to gel. And at any point, that manager you put in place could quit. And now, especially if you've got a full-time gig somewhere else, now you've got to step in and cover for your manager. That's where that initial stress and grind can come into play. So I think setting more realistic expectations about what it really takes to start a business in the first place is helpful. But then, as you say, I'm always wary of brands that sell multiple territories to a first-time franchisee in one shot, because they don't know what kind of operator that franchisee is going to be. Unless that franchisee has other, franchising experience, fine. But first-time business owner, and then they sell them, 6 territories. Well, I think the odds are pretty good that not all those 6 territories are going to open. So now that franchisee is out a pile of cash because they've paid all those franchise fees for 6 territories when they could have probably gotten started just fine with 1 or 2. And then if the territory doesn't open, and if they don't work with an attorney like you to make sure that the agreement is well written, then you can also get a scenario where that initial franchisee opens 1 or 2 territories, and then they've got a nice moat around themselves where you can't take that territory back very quickly, and you can't sell it. So now you've got, instead of 6 territories open, you've only got 2. And that hurts your long-term growth as well. So, I mean, all of these things you've really got to think through strategically with some good legal assistance to make sure you're lining yourselves up for success.
Those are some great points. So strategically, you're a franchisor. In this case, let's assume it's a service business.
Mhm.
Alicia's recommendation, the holy grail, right, is you need to focus on franchisee profitability. So there's the temptation to sell multiple territories. Brokers like that, sales organizations like it. The point to you is you're probably not getting much capital from those multiple territories because they're going to be paid in terms of commissions and fees to third parties. So you're not creating liquidity and capital for your franchise system. What you are doing, though, potentially is draining capital from your new franchisee partner, right? So he or she may have a little more stress. The other thing is, in Alicia's point of view, in terms of in the FDD item 7, the regulatory recommendation is 3 months reserve capital. I agree. Focus on 6 months. And I'll add another layer there, especially with service businesses and focusing on franchisee profitability. Most item 7s don't have a realistic expectation of what a franchisee needs to spend on local marketing, right? So I mean, if we're focused on franchisee profitability, if the franchisee just squeezed in and paid $150,000 to buy all these territories, I'd rather them have that extra $100,000 to spend on their local marketing to get the flywheel spinning and to build up toward that profitability. Those are such critical factors because now 5 years from now, is it better to have 20 validating, high-performing, single territory franchisees that have over time now added more territories versus selling 60 territories and having underperforming operations?
Yeah. In the book, I tackle this built to flip scenario where it's more and more common from my perspective to see young franchise organizations sell a ton of franchise licenses out of the gate. And look, it's a competitive market. There's nothing wrong with using outsourced sales help. Sometimes you need it. You can't get visibility otherwise because it's such a crowded market. But as you pointed out, you're paying out a lot in commissions. So now you've got much less capital to build your infrastructure to support all those openings. And that just essentially field strips your own EBITDA. So if you hit a stress point and you can't support those franchisees, now you're going to go to the market and try and find capital to help you get to the next level. But it's the multiple paid is based on your EBITDA, and you've got a bunch of cash flow that just went out the door and you're not ramping them. Keep in mind also the buyers value different kinds of EBITDA at different multiples. So one-time franchise fees are not nearly as interesting to an acquirer as recurring royalties. So if you can't get those units open, what have you created? You haven't really created much that's got significant value to a buyer. You're much better off to kind of ratchet the speed back just a bit and collect more in franchise fees to get yourselves open, get those units open, get the royalties performing, and show, the J curve moving up in a healthy way. And then you've got something that you can take to market, and you won't be quite as rushed to find a partner. You can take your time because you're not needing the capital so early.
I mean, you just bring up a ton of good items I want to dive into. How does private equity go about the valuation? What models are they looking at when they're evaluating cash flow and EBITDA? And, we'll get conversations all the time. What's the multiple that private equity is paying, right? What, from their thought process, how could a franchisor understand what private equity is going to look at if and when they're evaluating an equity position?
Sure. They value most recurring royalties, recurring rebates, the marketing fund, because that shows a sustainable, healthy business. Franchise fees are great to have, but they're not valued as highly because it's a one-time thing. So the challenge that we've seen recently is right after the pandemic, a bunch of businesses traded at pretty high multiples in like late 2020, all the way through 2021 and early 2022, when interest rates were cheap. Cheap interest drives prices up for acquisitions, right? So we have this scenario now where, let's say you acquired a business at 9 times or 12 times EBITDA, and you've got 6 times worth of debt on the business. Let's say it's a sizable business. If you were going to try and sell that business now, you might get only 9 or 10. So the math doesn't pencil. And we've got a bunch of sort of stuck acquisitions that are going to be difficult for the sponsors, the PE sponsors, to sell, or sell enough to make it worthwhile that they might have leaned into price a little bit in 2021. So that's going to make them more cautious going forward, at least temporarily, about how they value EBITDA, because they don't want to get ahead of their skis again, like they kind of are now. The good news is that it forces sponsors to really focus on true value creation initiatives, funding growth, funding marketing, adding support layers, adding new products and services, and the like, adding technology support to increase customer loyalty and frequency, because they can't depend on this tailwind of inflation in pricing carrying the business forward and driving a higher multiple when they sell it. They can't. It'd be nice to have it, but they can't count on it right now. I think Bain did a study where something like half of all the value created in the last 10 years in terms of multiple expansion was due to this inflation issue, not from margin expansion. So the PE sponsors now know this, and they're focused more on these growth initiatives. But what that means is they're going to put a lot more scrutiny up front on due diligence for new acquisitions, because they don't want to get ahead of themselves again, like they've kind of managed to do most recently. And that's why they want to be very careful about not overpaying for a sold not open funnel that may not be real. So if you've sold 400 units, you've got 30 open, that's a pretty big gap in ratio between open units and sold units. They're probably going to look at that 400 of sold units and say, we only think 150 is real. So that's what we'll pay you for. We're not going to necessarily lean into that entire funnel. It depends on the sponsor, but that's, we're seeing much more of that activity.
That's a great point. And so if we dive deeper into, what you're phrasing as growth initiatives. So I have 2 franchisors, A and B, both service-based, different industries.
Mhm.
Both have 150 franchisees, legitimate franchisees. If the equity values franchise B higher at a higher multiple based on growth, what they perceive as growth initiatives and the ability to increase, like what are some of those growth initiatives that would trigger for them, or that they would be honing in on, and like why B would be valued higher than A?
Sure. So let's say you've got these two companies in your scenario. The model for company A might simply be easier to scale for that franchisee for whatever reason. And therefore, they can say with more certainty, okay, if we put more marketing behind this, we believe that we can drive incremental top line growth to the business where we don't believe that's as easy of a task in scenario B. So they're going to look across all these levers of, where can they drive value and how realistic is it? And they'll be willing to lean into the future and pay a little bit more for a business that they believe has that potential compared to something that's not as proven or that is going through some sort of transition in their growth trajectory. So let's take another scenario. Let's say that you've got a system of 150 units sold and you've been selling steadily, but not a lot every year. And the average tenure in your system is 7 or 8 years. So now you've got some uncertainty baked in, right? Are all those franchisees going to renew? That's really important to that, the business case that they're signing off on versus having a system that's earlier. They've got, maybe they're less proven, but there's a lot more runway there for those franchisees to ramp up before they have to decide whether they want to renew or not. What's the history of the franchise in terms of adding other units? That gets buyers really excited. If 60% or better of the system is coming back to purchase more units, not buying them up front, coming back to purchase more territory, that's pretty exciting for buyers because that validates that franchisees are making enough money that they want to re-up and add more, right? So they're willing to lean into systems like that. Systems where, they do validation and franchisees say, hey, I'm good. I'm not going to add any more territory. That's not valued as highly. It just isn't.
We work with a number of our client brands are at, many times when private equity acquires a client, they start working with us, and exactly your advice, multi-unit franchisees in a system, to me, appears to be a very strong signal and indicator for private equity. And for other reasons, it's a very strong indicator of franchise system health, right? If you have those and again, not purchase all at once, but they just keep adding along the way.
Another interesting signal that we're seeing more is private equity activity at the unit level, right? So this opens some really interesting liquidity options for franchisees in some high quality systems. You're seeing a ton of PE activity willing to back operators who are consolidating a fragmented system.
Right.
Because they think the return is still a good one. They can buy units, 3 to 5, 6 times would probably be the max EBITDA, and then they're going to trade as a platform for 7, 8, 9 later. So the math pencils. But there's other systems where there's no PE activity at all at the unit level. It could be the system's too small. It could be they're not allowing PE in. It could be that it functions better as an owner-operator model, so therefore can't be consolidated under managers. Or it could be that the unit economics aren't that attractive. So I think in the long run, it's important for franchisors to also think through, would we like to have private capital in at the operator level? Would we like to, try to consolidate? There are some benefits to enabling that consolidation under strong, well-capitalized operators. But you've got to build a system that would attract that kind of buyer if that's something that's of interest to you. Or do you prefer to just have franchisees? Keeping in mind that when franchisees get ready to retire, if their only option is to sell to other franchisees, that is not as competitive a market where they could be selling to other franchisees, or they could be selling to private equity-backed operators. That just makes the price higher. So kind of thinking through the life cycle of your franchisees and how they will validate whether this has been a good use of their time and money is worth doing, even for emerging brands, to kind of soak on that a little bit and think about it.
I mean, you have this formula down. If you're involved in a private equity deal or a deal's going along, everything seems good. What are the reasons why, as equity, as your advice, you peel back the layer and then a deal's like, no, this isn't for us? What are some of the red flags that pop up in an acquisition that kill deals and just take things off track?
That's a great question. First thing is time. Time kills deals. It just does. People who had deals on the table in December 2019 and who dallied and said, "Oh, well, I want to close the books. I want to see if I can get a few more dollars out of this buyer." Boy, they were very disappointed that they didn't close in December, because the world shut down in March, a couple months later. So, if you've got, if you're reasonably close and you're pretty satisfied with where you've gotten to in your negotiations, I would say don't dally, because the world can change. It can happen. The second thing is that, buyers can change their mind. As a private equity firm is really good at doing lots of industry research. And so while the deal team is talking to you and, you're circling around the price and the terms, I guarantee that there's some analyst on that team that's continuing to study the market looking for gotchas. And at some point, if they find something that either wrecks their business case or maybe they find a more attractive target, they can go cold on you in a second. It's very jarring to many sellers. They start talking to PE and everything's great and feeling the love. And then all of a sudden, like, the love disappears. Where'd it go? Well, they changed their mind. They're professional investors. They're not emotional about this. They will literally turn on a dime. So you've got to be prepared for that. I think the third thing that can derail a deal is the quality of earnings. If you're serious about selling your business, it often is worth the investment to go and get a quality of earnings done in advance. So this does two things. It tells buyers you're serious, right? And the second is, if there's any gotchas in that QOE, you've got some time to potentially go and fix them before you go to market, right? So, but the buyer, the first thing they're going to do is get a QOE started once they're serious, and you can find things in that analysis that can derail a deal. And then finally, things that haven't been disclosed. When in doubt, you need to disclose. If you think that DUI that you had 15 years ago won't be found in a due diligence process, you are wrong. They will absolutely find everything in your background, and everyone on your management team and everything going on in the business. So just disclose it, because if it's old news, there's no reason to keep it secret. Just disclose it, because it makes you look much less credible. It's like, when is the other shoe going to drop? We're feeling really good about this, and then we find out this, and then we find out this, and then we find out this, and it dents the management team's credibility, and it can derail a deal.
I mean, you use the term, comes up often, and we get questions about it. For those that aren't familiar with the phrase quality of earnings, right? How would you describe that and guide on that point?
So what they're trying to understand is the cash flow, how the cash is flowing through the business, and how much money is through franchise fees, how much is through rebates. And they also look at different cohorts and vintages of franchisees over time, to understand, how different parts of the business are performing, so that they're really getting what they think they're paying for, right? So as I said before, different types of income are valued differently. So they're just trying to get more information about how things are really flowing through this business, so that they're not overpaying for one-time, lifts in the business. They're validating what's really going on in the business.
Have you come across situations where everything looks great, but from a compliance standpoint, they feel like the territory structures are off or underutilized, or compliance doesn't seem to be appropriate? And have you seen that impact deals?
I have. So on the territory piece, that's not a compliance issue so much as it changes the business case many times, where they may have built an assumption, or the banker might have built an assumption that tells a story of, oh, we've got, 500 territories yet to sell in the United States. There's plenty of white space for us to grow. And then you look at how many of the territories are designed, and you think, actually, based on this, it's going to take a while to unlock all this territory, and maybe there's only 300 to sell. Well, that's a very different business case, right? Very often, emerging brands will give too much territory initially, and then you've got to unwind that over time, usually by giving some sort of concession to the franchisee in order to break up that huge territory. But there's lots of great online tools and AI supported technology options to help you optimize territory. So they're really, in today's world, there really isn't too much of an excuse to do that wrong. You just need to spend the money and go find yourself a good real estate partner to help you do that well in the first place. On the sales compliance side, it can derail deals. If the buyer still has conviction that it's a good business and they find compliance issues, they don't have all the receipts, they hear things in the sales process that leads them to believe there's some risk baked in around seller disclosures or, earnings claims or things like that. If they move forward with the deal, it could scuttle the deal. But if they move forward, there almost always will be some sort of escrow or a rep and warranty insurance you've got to take out, or a seller's note, or retrading the deal. The price may come down. So that's the stuff you don't want buyers to find when they start digging. They will find it, I promise. And you can be very disappointed. I've watched sellers be very disappointed where they think they're selling the business at $50 million, and then you start unwinding and peeling back the onion, and now it's a $30 million sale with a big earnout and a big insurance policy and other things.
This is a great conversation. I can't even tell you how many times these questions come up, and for me, so frustrating because so many new franchisors, they enter the space with the wrong mindset. It's not their fault. I'm going to blame others. Beginning with the end in mind for the emerging brands out there, right? And I know at the top of the list, or the critical component, is franchisee profitability. What would be, as they grow over the next 2 years, what would be some KPIs or items you'd advise them to focus on? You'd be like, hey, talk to me in 2 years. And 2 years from now, I'd love it if you can say A, B, C, and D.
2 years from now, I'd like to see you're opening 100% of what you're selling. I'd like to see a steady uptick in unit revenue growth every year. I'd like to see continuing improvement in speed to open and speed to payback for those franchisees. I'd like to see franchisees returning to buy other territories. I'd like to see consistently good franchisee validation and franchisee surveys. Those are some of the key KPIs that, for an emerging brand, that's the list I would go down and say, if you come back in 2 years and all of this is good, and in addition, you've added, quite a lot of EBITDA because the business is growing, now you've got something pretty exciting.
I'd say that's some of the best advice I've ever heard for emerging franchisors. I think that's phenomenal. And it's a really good template, right, of those checkbox items. And so for everyone out there, like, stop obsessing over just those sold units or the ridiculous leads that so many development companies are wasting time on in these marketing efforts. And so I tell so many of our new clients to view the first 2 years as seasoning and building the foundation.
Mm-hmm.
And really amplifying what's special about their brand. Sure, we have the FDD and it's structured the right way. And okay, so what comes next? And then really diving into the brand and those uniques for the purpose of onboarding those perfect fit franchisees. But if you could add to that, Alicia, your advice that you just gave, I think 2 years from now, 24 months, 36, there's something very special, right?
Mm-hmm.
And I also, it's interesting because the brands that seem like slow growers, when you look at them over a 4-year time horizon, they seem like they're growing slow. And then you look at them over 7 years and, they're the winning franchise system. So
Yeah.
I appreciate that advice.
It's tough to unwind a false start, right? That's a lot of work. It can be very expensive. It's, if you've got a wrong fit or the model's not quite optimized, tweaking that midstream is just harder to do. Remember, franchisees are independent business owners, so you've got to get them on board, whatever your change agenda is. And sometimes they don't want to change what they're doing. So
calling it a false start is exactly what it is. The frustrating part, our team spoke to someone yesterday. What a passionate person. What an amazing story about how they built the business and their personal achievement. But their point is, they're like, hey, we feel like something's wrong in the way our territories are set up. And by the way, we sold franchises on our own, and we just can't connect the dots. And the difficult part is to tell them that you spent X dollars, you need to restart at least a good bunch, right? And that's always a difficult conversation, but I guess I'm grateful for those that at least 2 years in realized there was a false start and
Yeah.
could get on the right track going forward.
Well, and I don't want it to seem like we're picking on emerging brands. There are plenty of large systems that stall out. Those happen through more often not keeping up with the times, not investing back in the business, not um, not keeping franchisee profitability front and center. Large systems can forget to do that too, and they can stall out, and they've got to do a reboot.
Which is a great point. And by the way, I focus on emerging because I'm a fan of the emerging brands. I want to kick the whatever out of every established brand out there and have, but it's interesting because when I sit through meetings or have conversations, especially these, I won't, not clients, but I see many large franchise systems with layers of management. I'm like, they got really soft. And everyone's like checking the box on here's our core value and here's the market we serve and we do A, B, and C. It's like playing corporate executive. I'm like, you're ripe for the taking and you're not going to succeed.
Yeah.
Well, I definitely agree with that point. I think there's many large systems that are out there. And for me, when we work with our emerging brands, my point of view, and I believe 100%, these larger companies and systems are ripe for disruption.
Mm-hmm.
And I love when, sophisticated equity and sophisticated companies come to buy our client brands, right? Because the value was created. So even though you're smarter, quote unquote, you're paying top dollar. And so I agree. There's opportunity. Genuinely, the advice you gave, if for everyone who's watching and listening to this video, go backwards a little and we'll highlight those points. Focus on those things over the next 2 or 3 years. And for sure, Big Money in Franchising is on Amazon. We'll have a link up here. I promise you, been many conversations with sophisticated franchise executives, and they brought up the book without me even discussing it. So go get the book, and we'll have Alicia's information up here also. This is real advice, and I appreciate it because there's a lot of noise in the industry, and as far as I'm concerned, a lot of BS, but this is pure good advice and beginning with the end in mind. So I appreciate it.
Thank you, Charles. It was great to be here.
Was it really great though? It's not that much fun talking to me, is it? No,
I love talking to you, Charles.
All right, good. I could be boring though sometimes.
No,
I appreciate
I love your focus on emerging brands. That's where the innovation's really happening. That's where the energy is. And all we want, all of us collectively, is to try to help them succeed and to really, achieve their dreams. I think it's exciting. And I love that there's so many emerging brands every year. We just want to help them, ultimately be successful, avoid the missteps that are so avoidable.
Right. And I think back on the journey when I look at a client that,
Mhm.
and again, everyone takes credit, but the success always comes down to the founders, right? And the leadership team and rolling up their sleeves and focusing on the brand. But it really is special watching that journey from one location to hundreds or one location. We have a client, he's very happy. He's a reluctant franchisor. He's got 25. He's like, I don't want more than this. Because he's obsessive. It's great when I see the person who's now a corporate executive in the franchise company. But when we first met, he or she worked in the local branch of the, original company. So there's special things happening. I think there's opportunity. I think there's challenges, and hopefully this added to success for some of our brands out there. Thank you, Alicia.
You're welcome.